Let me kind of bring it to a real life example. So let's say I'm one of the passive investors. I work, and my income level is 25%. My income is $100,000. I will keep the math simple, right? And I want to deploy $100,000 of capital into real estate, right? And at the same time, two things. I want to invest my money into real estate, and I have a 25% tax bracket. And at the same time, I want to break my 401k into a solo 401k because I have to. I cannot do UBIT anymore. On that note, and okay, and to make it crazy, I'm not a real estate professional, right? I can. So would you say, can I stack it where I deploy $100,000 of capital investment and I get $50,000 loss? So my income bracket doesn't may or may not go down, but I can use that loss to transfer my money into the solo 401k. What's your thought on that one?
Yeah, it's a lot of those are good. A lot of the planning, it comes from knowing what your income is. And again, so you're not crying, thinking you had a refund and you end up owing, or you're kind of like at the roulette wheel, hoping, okay, I'm going to bet it all on black. It's one of those. Start to think about what you're doing now. Maybe you will owe some tax, but it's better to know that now than to find it out on April 14th. So just again, it just becomes some of the planning, using the different tools available, using the solo 401k when appropriate, which means you actually have a real business going. It's an excellent opportunity. There's also really nice things in the solo case as far as timing of when you do it. Solo 401ks can be they don't have to even be for an LLC. You could be self-employed with no LLC and do that. And there actually are benefits of having a sole proprietor business that's not in an LLC when you have children. Because if you put your children on the payroll, they actually do have to do the work. If they're under 17, you're not paying the Social Security and Medicare tax on them. It's almost like the first $12,000 is tax-free. Then maybe, you can even do 401k plans. Then you take that kid, put their money into the Roth 401k, and you're just expanding the possibilities of what you do. Just don't get, hey, I see 66,000. Okay, I'm going to put 66,000 away. It comes back to, you can only defer it if you have income. If you're not getting income, well, it's not a $66,000 deduction. It's a way to shelter the income you have, not create expenses out of nothing. Kind of like you can't just buy assets and write them off because, well, I spent the money. That's just not how it works.
Going back to it, it boils down to planning by having a starting point, which is go to last 2 years tax, then look at what that income and the expense and the tax paying structure looks like. Then you put the 2024, and then you go straight down. Now understand that all of those takes time. And then on top of that, once you decide, you'll come up with a strategy. Then you have to go decide where do you go deploy it. So now we're going to go into, let's say you reached out to Bill, and Bill looked at, and Bill says, yes, it doesn't work for this year. You're ready to pay the tax. They said, okay, that's fine, Bill. Or he said, yeah, it looks like you are going this way. Maybe I have to restructure it that way. And hey, you need to go invest something. Where do you go to? And at that point in time, you got to go pick and choose. You have to, decide where do you deploy the money. That's the last leg of this presentation. And Bill, if you don't mind, if you do mind, sorry, if you don't mind, if you drop your contact information on your admin on the chat, I'll really appreciate it.
Yeah.
So, okay.
On the past, what we've been doing is you email me and I do the connection.
Thank you. Thank you.
So I think I'll put my email in the chat. If you want to connect with Bill, that just saves Bill doing our work.
Appreciate it. And Robert, you're right. I love the comment that you're doing. Absolutely. I started the backdoor first, then I increased the backdoor as I went in, and then that worked out. And then we went to solo 401k. And on that note, just to kind of give you a little hint, not that like a small realization that I had, I used to work at Shell. I had a pension. And once I left after 17 years, I realized the pension grows at a 3%. So if inflation goes at a 3%, your pension is not growing in that sense. And if inflation goes up 1 year, you are back 2 years. So you can go, if you have pension somewhere else that you left, go ask the custodian what is the rate that pension is growing at, and then do a calculation if you took a lump sum, and then redeploy how many years you can kind of get ahead, right? It's interesting. financing calculation. All right. So now it's a decision time. So going back, you're active. So all of us were active. We have a decision where we're gonna go. The first option is right here. We have a multifamily. Uh, we have a multifamily property right here that is a cash flow plus depreciation. And in this particular case, if you're looking for depreciation, then you should go into multifamily segment and making sure that not only you have a product, you have a project to deploy the fund into. And the second thing is that the project must be closed this year. So if you don't have a project that to identify, then you are looking for someone to close, that uncertainty is there. So that uncertainty is there. So you're making sure that multifamily assets, you know, I mean, multifamily project available in front of you for you to invest. And then what's the depreciation look like? So have a project horizon, that's the cash flow. Here you can see our maximum available is 60%. So every 100, then we kind of played it a little bit. It's this project, $100,000 investment gets $72,000 of paper loss. About $40,000, $39,000 comes in this year, and the rest goes up. Now, two things. Bill, would you mind talking a little bit about what happens if I have depreciation, but I'm not a real estate professional versus I'm a real estate professional?
Yep. So a couple of things, and it often depends on if this is your only deal or if you're in other deals. Now, a quick thing to say, you might be in 100 different deals as a passive. That is not going to make you a real estate professional. There's actually very specific rules to be a real estate professional with active participation. It's spending at least 750 hours a year in real estate. And those 750 hours have to be one more hour than half of all your time. So like if you work a job and you work 1,000 hours at the job, but you put in 900 hours in real estate, you're not going to qualify. If you have a regular job for 1,000, you need to spend 1,001. On top of that, you have to have 500 hours of active management, i.e. being a landlord. But now back on the passive side, if you are building up losses through your passive investment, it's going to be held behind glass. And that glass is going to say break in case of profits. So they're not gone. You just most likely will not be able to take advantage of those losses. And again, we're talking not IRA, not 401k stuff. This is regular after-tax money. But it doesn't mean they're gone. You're going to hold them. And then somewhere down the road, especially if you're in multiple investments, you're going to sell at a gain. So imagine, say you've got 5 investments and each one of them has built up 20,000 worth of losses. So you've not been able to deduct them on your taxes. And then you sell one of your investments for a gain for 60,000. Well, what's going to happen is those 5 times 20, that's 100,000 of losses. You sell one for 60. The first 20,000 comes out of that one. And so that brings your 60,000 gain down to 40. And then you'll take 10,000 from each of the other losses. You're going to pay no tax this year. It's actually what we kind of call like a lazy 1031 exchange, meaning you don't have to do an official 1031. You're just not paying tax on the gain because you have losses to offset it. Whether you invest into another deal or not, you've used those losses from your other 4 deals, which means you can't get 2 bites at the same apple. But for the time value of money, you're not paying any tax. Now, slightly different situation. The one I said had losses in the front, gains in the back. Say you sold a property, you were in a property, you only had one passive deal, and it sold back in January, February, and you had a pretty large gain. And now you're getting to the end of the year like, oh crap, I really don't want to pay tax on this. If you invest in a deal and that deal closes before the end of the same calendar year, you can use the losses from that deal to offset the gains of your earlier sale. And here's the really nice part. Gains might only get taxed at 15%. Might be 20, might be ordinary. It depends on depreciation recapture. Let's just say 20% on average. But kind of like in that earlier example, the person's in the 35% tax bracket. So $100,000 gain is going to basically cost them $20,000 in tax. But if they have just a $50,000 loss. So 100 gain, but a 50 loss. That 50 loss at 35% means they're going to save 17.5 in tax. So they're actually not, it's like they look like they're up $50,000 and it's costing them 2,500 in tax. And so you don't have to have the same amount of gains as you do losses to not pay any tax. Now, say that same example, you invest a lot of deals. You have 100,000 gain and you invest in several more deals and it builds up 120,000 of losses. What's going to happen? It will use 100 to offset those losses to break even and carry 20,000 forward. Now, a normal person probably thinks, okay, 100 of gain, 100 of losses, I broke even, right? No, let's go back to the tax brackets. Your 100 of gain cost you 20,000 in tax. Your 100,000 of losses saved you 35,000 in tax. You're actually getting a $15,000 refund for what looks like you broke even.
It's pretty powerful. You're
Sorry.
on mute, Gerard.
Thank you. The timing of investment, it's really powerful, right? Now, Bill, just to kind of push the envelope a little bit more, what if I had crypto went up, I wanted to realize some profit, I sold some crypto or some stock. Can I stack it with real estate loss with the crypto profit?
So no, unfortunately you can't. Those, while they might think of passive because you're not doing any really work, the passive losses can only offset passive income. Now, something that's slightly different than what you just said. Say you sold a lot of that crypto a few years back and you lost a lot of money. And now the government's saying the most you can reflect is $3,000 per year. And so you're sitting on 120,000 of losses. 117, 114, 111, 108. So you're sitting on, say you get down to 100,000 of losses. And you've also got 100,000 of passive activity losses. And so you're like, I can't deduct any of these. And one of your deals sells and it has $100,000 passive gain. So not a stock gain, but a real estate gain. Well, that real estate gain is going to show up as a gain and free up your prior crypto losses or stock losses, whatever. And it's going to free up 100,000 of your passive activity losses. So now you're like 100,000 of income, but 200,000 worth of losses. So all of a sudden now your capital gains, those go to zero, and you're just taking a straight $100,000 loss to offset your job income, your W-2 income, or that might be a very good year. I'm going to convert 100,000 of my pre-tax IRA, and it's kind of like, and then convert that into a Roth IRA.
Going back again, having a little bit plan, spending the right time with the right set of people, giving them the right context, or really make it interesting, and it's well worth of your time. Spend the 5 or 10 hours, go schedule a call and just sit down with someone, spend the time. We still have 8 weeks. If you make it, if you can save the $10, $15, $20,000 this year, why not? Nobody's gonna give us $1 for free, right? Go earn that. It's just like the money is there on the table, it's ours to lose, right? So that's one. Now let's look at it. We have an IRAs or solo or Roth IRAs, and I want to get an investment. And then what does that? I mean, how would that work out? Because I cannot get depreciation. Then you should bias towards new construction, because typically new construction are faster pace. On a multifamily side, those are larger assets. I mean, it takes a lot of time to get situated, go turn, then go increase the profit, then exit. It's about 5 years, what we call it. But new construction, standard rule of thumb is 3 years in and out. So what happens? You get to bring your money back first, and within 3 years, without the depreciation. So you're letting go the depreciation, but you're gaining the speed, right? So we would say that one of the good ways to place your IRA money is for the new investment. They tend to have a higher return because of the lower velocity, offset the depreciation, right? With the higher return, you can recoup some of the tax you're going to pay. So net, you'll get the similar type of benefit, right? So we have one of those as an example. It's a Class A retail center in Katy, Texas. This looks like the IRA money you cannot realize anyways, so you don't get the cash. But also it doesn't really matter because you don't get to use it. The IRA money stays in the IRA, then you get a big bang out of it, right? So go in, and you get a big bang when you sell it, versus on a cash flow, You can get the money to your bank account. This is tax optimized, right? And then you can use that money for something else. So if your money comes from a non-IRA account, usually you want to place on an asset that has depreciation or steady state cash return, and the money comes out of it, out of your IRA account. Your first priority should be, look at a land deal, and then look at a new construction deal, and
Yeah.
then where you don't have to worry about the cash flow, right?
Something even slightly better now if you're using IRA money on this one. Preferred returns are considered guaranteed payments for use of capital. It's a fancy way of saying interest income. So you're not making profits on leveraged money. It's almost like you're letting somebody borrow your money. Guess why that's nice? No UBIT. You make the profits on that, you're not paying the UBIT tax inside your IRA because it's not a gain. It's another fancy way of saying interest income.
Well, that's
And
awesome. So
I put a
7%,
link
like
I put a link in the chat. So we have a webinar tomorrow at 6 about this new development opportunity. And then we actually have a webinar at 7 about the multifamily that has the bonus depreciation. Tomorrow's a busy day. We got a lot of webinars.
So we have 2 webinars happening, one for Horizon tomorrow, one for Candela tomorrow, and then I'll be in Total Wealth as well. Again, these are your examples. This is how you start from your tax strategy to have a conversation, figure out the action. Once you get the actual plan, you got to deploy the assets, and we're giving you live case studies as you kind of go through. And the last thing, what we call it, we have 2 options. Either we be actively passive or we be really active. So if you want to be actively passive, you just come to our websites. Oops, picture didn't show up for some reason. Sorry. This is supposed to be our website, and it's supposed to be apply for Expo. I am not sure what happened, but sorry about that. I am not sure, but hey, so we have 2 options. You can go down to massive.capital. You can see our Horizon there, and also Candela there. And Trevor, if you want to put the links. Oh, thank you for
Put
sharing
the
the
links
link.
in the chat. Yeah, I did already.
Yes, and if you choose to be really, really active, like really, really active, every 6 weeks we host a 3 days event that we go through all the asset classes. One of the difference between us and other teams is that we look at the portfolio as a de-risking. We believe just having one strategy, one type of asset, and one type of price point, and one city, it puts you in a very tough spot if you were to grow. And what you have to do, you have to go shop around, right? You have to go from one team to another team to one product size. So we, just like you, invest, right? We have land buckets. Again, going back to early on, we mentioned that land we like it because it's a downside mitigated. Upside, if it happens, it happens. We have a limited upside, but the downside mitigation. So we are part of our portfolio. It's on the land banking. Like that's like a city, right? It's not gonna move much. If it goes, it goes. But the downside is really important for us. Second thing is the speed of the return. That's where the new construction comes in. We love the Class A. We can compete on a Class A because company, that's one of our sister company, Realty One, they own the construction company. So we can compete on the marketplace because we are building at cost. Then we look at the multifamily side. We are in a B to B minus zone. That's where we look at it of the Sun Belt. So we compete on the operations. So that's how we take a look at it. And that's how we build our portfolio. That's what we said. And I mentioned to all of investors is to look, build a portfolio, just like your stock market, build a risk distributed portfolio where you have different asset classes, different location, and a different time horizon to deploy your capital, and it kind of go. So